I'm gonna start this video off by saying I don't agree with Warren Buffett. That's right. I don't agree with Warren Buffett when it comes to him saying all investors should just invest in index funds for the rest of their life. And the reason why I don't agree with that is because it's not real hard to learn how to pick stocks. So today in this video, I'm going to give you a blueprint on how to master the art of picking great stocks and how this will increase your returns significantly. And you don't have to just stick with using index funds. And I'll tell you why. In 2023, the market returned 24%. As an individual stock picker, I returned 33%. In 2022, the market returned negative 13%. I returned positive 15.65%. And I show it each and every week on my show, Trapping Tuesdays. I show you my portfolio with real money so you can see it. Now, I will say this. Most people would have to go the Warren Buffett route simply because you're not willing to do the homework. You are, my friend, a lazy learner. And if you're a lazy learner, you will get poor results. But if you can dedicate a little bit of time to your day and use this strategy that I'm gonna give you right here, you will see your returns skyrocket. I promise you. And it's the reason why Warren Buffett only owns 0.03% of his portfolio in the S&P 500. Why? Because he knows that those subpar returns won't get you where you gotta go at. I personally use the VOO as a savings account. That's right, I use the VOO as a savings account. So each and every month, I'm putting money in the VOO as my savings account. Because when the market is doing good, my savings is doing good. When the market is doing bad, my assets are still growing. I'm still doubling down. My dividends is reoccurring for that. It don't pay much. So I'm winning. I am winning. So let's get to it, y'all. Get your pen and your pad. Like, subscribe, share this one because this is going to be good. The first thing on the list is you should only invest in companies that are simple for you to understand and predictable. Right? So simplicity wins this game. So simplicity wins this game because if you do not understand the company, you put yourself at a disadvantage. Now, I know some people are going to come to you and say this stock is running up 100% and 200%, but if you don't understand that business's core business, meaning how they make money, you won't understand what's wrong with the company. And you'll be waiting for the stock to fall before you get out. You'll be waiting for people to start selling before you get out, which means you'll be left holding the bag. But if you understand how a business makes money, and then you start to see the business declining in the prime areas that they're making money, and you see that the management team isn't fixing anything to help them get back on track to making money, you know that this company is not just a troubled stock, but it's a troubled company. It's not just a troubled stock, but it's a troubled company, and we don't want no part of that. So simplicity is key. Next, is the company's free cash flow and profit growing? Now, you can look for that on your balance sheet. You can see that. And you can look on the cash flow statement. The cash flow statement, you'll see the free cash flow. This is the money that is left over after the company pays everything. This is the money they use to do share buybacks and to pay dividends. This is the money that they use to do share buybacks, which means the company is buying billions of dollars of their stock off the market, which causes the stock price to go up. And this is the money used to pay you dividends. So is the free cash flow growing? You look at that on the cash flow statement. And is the net profit growing? You can look at that on the balance sheet. You want that. Number 3 on my list is, do they have a competitive advantage? This is called a moat. You think about a castle, think about the moat built around it. It is not saying that enemies won't get in, but it's saying it's going to make it rather difficult for them to get in. A competitive advantage is what does your company do better than its peers? Right? Now, it is possible to be in a company that the moat isn't big, but it is enough. So let's think about this. Let's think about a company like Amazon. Right? Amazon is the largest web service in the game, Amazon Web Service, But also, Amazon has what? Amazon Prime. So they're a great what? Retailer. Think about Walmart. What is their competitive advantage? They are what? The low price leader, right? Think about that. Apple, what is their competitive advantage? Well, it's not so much the phone, it's the network. Apple finds a way to get us in the database. And once we get in the database, we have everything attached to what? The cloud. Now, what is the inconvenience of us taking our information from Apple going to another phone? It's pretty hard. Why? Humans don't like to be inconvenienced. This is the one thing we don't like to do. Another thing is certain banks, right? JP Morgan Chase, certain banks, their moat is called the switching moat because it's an inconvenience for you to leave their database. So what is the competitive advantage? I want you to identify it. What is the competitive advantage that a company has over its peers? Oftentimes, you can go read a company's 10K statement and they'll say it in the business part. I'm giving you a gem right here. The next one, does the company have a high ROIC, return on invested capital? This tells us that a company can take money, go put it out there in the world, in the marketplace, and get a great return on it. Does the company have a great ROIC, return on invested capital? That's telling us that a company can take money and put it back in the marketplace and make a lot of money on that money. That is key. That is also a sign that a company is good at generating profits. Number 5, is the management team good? Well, Trap, how do I know the management team is good? Great question. First thing is in the finances. Does the company have a lot of debt? You could go on the balance sheet. If the company has 2-to-1, here's my thing right here. A company should always have 2-to-1 more assets than liabilities. Meaning, if a company got 2 assets, they got 1 liability. If they got 3 assets, right? 2-to-1 is what we want. 2-to-1. Well, 3 assets, 3-to-1. No. 2-to-1. We want it to be 2-to-1. If they have 3 million in cash, you want them to have $1 million in debt. There we go. They have 3 million in cash, you want them to have $1 million in debt. 2-to-1. I gotta make sure I get y'all the right numbers. Because I want y'all master this, it's gonna help you out. 2-to-1 is always best. Also, I'm gonna stay there a little bit. So when you go to a company's balance sheet, you go look at that liabilities and you go look at that assets. You want those assets to be you want a 2-to-1 ratio. So if they got $3 million in assets, $1 million in liabilities. 2-to-1. Anything better than that is phenomenal. 1-to-1 is anything negative, we don't want it. Unless, hear me right here, unless it's a growth company in the early stages and they're giving us a path to profitability. Meaning, the CEO or somebody is telling us, we're gonna be profitable in this amount of time. 1 year, 2 years. Amazon was not profitable for 20 years. But Jeff Bezos kept coming up telling people, we're not profitable, this one will be profitable. Tesla just became profitable a couple years ago. Uber just became profitable 2023. The CEO should be able to tell you when we are going to be profitable, and you are seeing the progress in what they're saying. Oh man, I want y'all to really look at that one. Next, are they an industry leader, or where are they amongst their peers when it comes to size and profit? Now, don't always look at dollars right here when it comes to profit. Look at percentages. Look at profit margins. Here's why. NVIDIA is $1 trillion business. AMD is not $1 trillion business. They're still in the hundreds of billions of dollars. So if you look at NVIDIA and you look at AMD, if you just looked at numbers, you'll say that NVIDIA probably makes more money than NVIDIA. But if you went to percentages, they'll make more money than them because they're a bigger company. But the percentages is what tell you. So you want to look at, when you're trying to compare companies, you want to look at What is the net profit percentage? That is more important than the dollar amount. Man, I want y'all to get that. Also, are they paying down debt? So another thing to do is go to liabilities, and then you want to go look at debt. And you want to see those liabilities consistently shrinking. Now, you want to see the liabilities shrinking, but you also want to see the revenue and the bottom line growing. Come on, man. Come on. I'm trying to get y'all the game right here. Number 7 on my list. Don't worry about it. Does the company buy back shares and dividends with positive free cash? Say that again. Does the company buy back shares and pay dividends with positive free cash? Meaning, when a company is buying back shares or the company is paying dividends, is that going into the negative? Do they have to take on debt? If so, that is not good. You don't want to be a part of a company that is taking on debt to buy back shares or to pay a dividend. Last but not least, I want to ask yourself this question. Is the company, or has the company ever, if they pay a dividend, have they ever halted or frozen the dividend? Has the company ever halted, means stopped, or frozen the dividend? Listen, you can use them 7. And I promise you, them 7 now gonna make you a great stock picker. You learn how to pick stocks, you increase your returns. You increase your returns, you grow your wealth faster. It's not about making $1 million. It's about, can you make $1 million faster than they told you can make it? I hope y'all love this, man. It's your boy, the Wall Street Chapman, man. How to master stock, the art of stock picking. Listen, I'm getting real masterful at this thing. I think right now we up 26% on the market. Last year we did 33%. The year before that we did 16% in a negative market. And we gonna just keep running, and I wanna show you the game. It's your boy, the Wall Street Chapman, man. Make sure you tap into my show, Trapping Tuesdays, each and every Tuesday at 7 p.m. Eastern on the Wall Street Looks Like Us Now network on YouTube. Also, download it on all podcast and streaming platforms. Also, that's not me in the chat asking you about Bitcoin. I'm not gonna ask you about Bitcoin. That ain't my thing. So don't fall for that, man. Listen, man, make sure you like me, subscribe. I love you, I appreciate you, and I'm out.